Okay, so just a quick announcement is that the next 2 weeks there won't be any weekly market analysis because I'll be doing a special training program for my subscribers only. Alright, so this means you won't see it on Facebook, you won't see it on YouTube, you won't see it on Twitter, but you'll only see it if you are on my email list. So if you want to be part of my email list, you can just click the link below, right? You can join and download the Ultimate Guide to Price Action Trading as well. This is completely free for you, right? So just click the link below if you want to be on the email list. Okay, so that's it, right? Now let's look at this week's market, and I want to share with you a few trades that I took. Right, I find that over the last few weeks, last few months, I've been sharing a lot of tips on trading, right? And there's not so much on me actually sharing with you the particular setups that I take, how I manage it, and stuff like that. So this week's market analysis, I want to focus more on this. So the first thing that I want to look at, all right, is, let's see, Euro Aussie, shall we? We talked about this last week, right, about predictive and reactive analysis. So Euro Aussie is a trade that I took, and so mind you, I just want to share with you that I have two trading accounts. One is a trend following account where I try to ride with the trend, right, as much as possible, and another one is a swing trading account. So the main difference between the trend following and swing trading is that it can sound a bit contradicting, but they're actually sometimes at what they call opposite end of one another. For example, let me explain. For this setup over here, the Euro Aussie, from a trend following side of things, right, I'll be looking to trade this breakdown, right, this breakdown over here, right, in anticipation of lower prices. But from a swing trader's point of view, what they'll look is that this is an area of support, and they look to trade the reversal back up into the range once again. So now, don't get me wrong, there's no right or wrong, there is no best way to go about it. Rather, it's more of a method that appeals to you and something that you find that you can actually execute consistently over and over again. And for me personally, both method works fine. This is why I actually separate out this two trading approach into two separate accounts. So for the trend following side of things, right, I basically shorted the breakdown of this low over here, right, with a sell stop order. I risk 0.5 R on this trade. My intention is to risk 0.5 R when price traded below this low, and if it can close below this low over here, I'll add in another 0.5 R. So obviously it did not close below this low, and right now price is against me. So my stop loss is currently above the 20 period moving average. If it closes above it, right, I will just exit this trade. So possibly for a 0.5 R loss on the Euro Aussie. Okay, so that's the trend following side of things. So now, just to share with you more about the swing trading side of things, right, because at this point in time, I'm not really in too many trend following setups. Another one that I think I can share with that you've probably know already since we talked about last week is this S&P over here, right? This is again another very typical trend following setup where I went long on the break of this high over here. Then price this time round went in my favor. But for the swing traders who went short at this high over here, they would probably cut their loss. So this is what I mean by trend following and swing trading. Sometimes they are actually at the opposite end of the spectrum, right? So this is why you have winners and losers, and this is basically a zero-sum game, right? Trend followers tend to profit from traders who short the resistance or long the support, and swing traders who actually trade from these areas tend to profit from trend followers who anticipate this kind of breakout. So again, there is no right or wrong down here, right? The reason why both method can exist and be profitable to trade is because of your risk management and your trade management, and that's the secret sauce if you wanted to put it across. Okay, so back to this market. Sorry to move sideways for a while. Is that again, right? I'm in this trade. I'm long and currently trailing my stop loss using the 20 period moving average, right? And it's pretty much logical because you notice this market has been respecting the 20 period moving average. It has not closed below it for since I think June. Right, sometime late June. So needless to say, if it closes below it, I can manually exit this trade, right, for the S&P. Okay, now let's move on into the swing trading side of things, right? Perhaps this is something that will be newer to you since I don't really talk much about swing trading. Well, I do talk about it, right, off and on. But again, swing trading for me is the same thing, right? Even though I'm a swing trader, I still trade with the trend. So this means that the main difference between trend following and swing trading will be for me is that trend following, I ride the trend for as long as possible, for as long as I can. For swing trading, right, I don't ride it as long. Right, I try to have more consistency in my swing trades, meaning the average profit won't be as large, but the consistency, the win rate is down there. Okay, so for the swing trading, is this one I took was the pound yen. So I believe I talked about this maybe, a few weeks back, but, just to refresh your memory. So pound yen, Brexit, this was a Brexit event, right? Massive sell down over here. So as price, it was, did this brief rally and then it trades lower once again. I'm asking myself, where is an area of value that I can trade from? Because obviously, if price is over here, or over here, you don't want to be trading at these areas because, there is no structure that you can reference from. So for me, when I look at this chart, right, the first structure that I look at is this high over here. This is the high I look at, and perhaps this high over here. So these are the two structures I was looking at, and possibly even this, right, previous support turn resistance. But nonetheless, this was the first structure I'm looking at, the first structure high, swing high. So I'm asking myself, right, how would I know when price is showing signs of weakness at this area over here? But this is the question, right? Because I don't want to blindly just go short at this market and randomly put a stop loss maybe somewhere here. I want a market to tell me that it is showing sign of weakness, right? The bulls are unable to push price higher. This is key, right? The bulls are unable to push price higher. So this is what I want to see. So obviously on a daily time frame, right? Because the candles are, on a daily basis, it's a bit hard to read the price action down here. So what I did was I went down to the 4-hour time frame, and now we can see better, right? So this is basically the same high we saw earlier. Then price basically, price basically broke through the high, right? Then it retraces, attempt a rally, couldn't. The bears came in, pushed price lower, almost retesting these lows. Then the bulls came in once again, right? Trying to attempt the breakout, because this time around you see the strength is pretty strong, because within 3, 4, 5, 6 candle, retesting these highs. Then the bears came in, pushed price lower, and then it starts to consolidate. So at this point of view, right, you can see from a structure perspective is that the market has basically went into a range, right? A range. So you can think about this, right? Traders who basically went long on this breakout of this high over here are basically so-called trapped, right? They are trapped. Why are they trapped? Well, if you long the breakout over here, where will you put your stop loss? Well, chances are your stop loss will be below this low, or below this low, right? It's a good general idea. So for me, right, I'm thinking that I want to short this market because, as you've seen earlier, the trend is towards the downside. So I'm looking to short this market, and if I were to trade with placing a sell stop order below this low, I know that traders who basically went long, right, would, chances are, bail out of their trade because, it hit their cluster of stop loss. So that's what I did, right? I placed a sell stop order. I believe it's either below this low or below this low, right? My stop loss is above this high. So we can see that price trigger my entry, right? I had to endure a little bit of retracement, but this retracement is something that I'm comfortable looking at, because if you look at the size of these candles, right, these body candles, it's very small, right? You have 1, 2, 3, 4, 5, 6, 7, 8, 9 to 10 candles. Okay, so you look at this sell down over here. 1, 2, 3 candle sell down, and you need almost 10 candles to retrace back this amount of the move that it's sold down. So this is telling you that the bulls are having difficulty trying to recover, because the bears took 3 candles and moved this much, and the bulls take almost 10 candles to move from here to somewhere here. So you can see, right, the bulls are showing sign of weakness. So I'm perfectly comfortable looking at this retracement. So I endured it, and then price eventually went back in my favor, and and currently in a profit right now. So since this is a swing trading side of things, right, as I mentioned, I want to actually have more consistency in my trading. So how I manage this trade is actually I took 30% off the trade at 1-to-1, right? When I hit a 1-to-1 risk to reward, I took 30% of the position off. And the remaining 70%, right, I'm trailing it using the 10-period moving average. Why the 10-period moving average? Is because it is a smaller number, so it's going to be more responsive. And as I've said, right, I'm not trying to write a trend down here. I'm trying to get more consistency in this swing trading account. So the 10-period moving average is basically just to catch move that looks like this. Bam! Just one nice swing towards the upside or the downside, right? I'm not interested to catch moves like this where there is a very steep pullback. I mean, there's a pullback, because chances are if this pullback come, right, it will be crossing beyond the 10-period moving average, and I'll get stopped out of the trade. So for my swing trading account, the moves that I'm interested to catch is this kind of moves down here, just one swing, right? Hopefully the swing lasts, pretty long. Okay, so this is the pound yen trade that I took, right? I hope this helps. So another trade that I took, just to share with you, is the Aussie Swiss franc. Okay, so Aussie Swiss franc price came into this area of resistance, right? And then, I mean, candlestick pattern traders would realize that this is actually, we have this bearish pin bar, 1, 2 over here. But I didn't trade this pin bar, right? I basically look at the structure of the market and found weakness in the pullback by the bulls, right? So let me explain. On the 1 hour time frame, right? Okay, let me just get the lines out. So this is your area of resistance. This is the high. So on the 1 hour time frame, what I noticed is that the market at this point in time still looks fine, right? You have a higher low, higher high, higher low, higher high, higher low, higher high. So you have higher high and higher lows. At this point in time, the bulls don't look like, it is what they call losing control, right? They are still forming higher highs and higher lows. So, things are still looking fine. The first clue that the market gave me was when this market traded lower, as the candles get larger and larger, this impulse move getting larger and larger, and then it took out this lows over here. So this is the first clue, right? So that is fine, right? The market has actually took out this lows, but I'm not interested to short yet because I want to see that the counter attack by the bulls. I want to see how strong it is. So this is so-called the counter attack by the bulls, right? Where they try to stage another rally. But this time around, the rally gets weak, right? Because you notice, again, excuse me. Because you notice the rally here, right? The candles again are getting smaller and smaller, smaller bodied candles. So if you have smaller bodied candles by the bulls, what's it telling you? It's telling you that they are lacking strength, right? Because they are unable to push price higher. Because if they are, having signs of strength, right, you will have these big, large bars over here, and over here. But apparently, it's not happening right now. So when I saw this, right, again, this is a little clues to tell you that the bulls are getting weak. So when I see this, right, then I was having the intention to short this market, right? I think that it's already primed to attempt a shorting opportunity. Once again, right, there is no guarantee that, my approach is the holy grail or it's going to work 100% of the time, right? In fact, this will still result in losses, but honestly, what you're doing is just basically stacking the odds in your favor, right? Trading from a structure, support, resistance, right? The trend, and waiting for a sign of weakness from either the bulls or the bears. So what I did is I placed a sell stop order below this low, right? In anticipation that if the bears were to come in, right, they would take control and push price lower. So stop loss is above this high, and right now seems to be slightly in the profit for me on this trade, on the Aussie Canadian. Again, the same risk management, right? The 30-70 risk management that I'm using, the trade management that I'm using. Because for my swing trading side of things, it's pretty much very mechanical in terms of trade management. 30% I take off at the 1-to-1, and the remaining 70 is trailing using the 10-period moving average. Now, if you think that, this is cherry picking examples, obviously I'm cherry picking the charts, right? Because I find that it's much easier to illustrate my point. Now, to show you the ugly side of it, right? To show you that, it's not always, sunshine and roses. So this is the chart of the 30-year bond, the daily time frame. Again, we are in a trend. So price has actually retraced back to this area that was interest to me. Okay, because you have this previous high. Now, previous high would turn area of support, right? So this was a key area to me. So on the 4-hour time frame, what I saw is that the market formed this inverse head and shoulders pattern, right? And this was basically the area of resistance. So I went long on the breakout of it, stop loss below this low. So I can tell you that this wasn't an easy trade to hold because it's basically just whipping back and forth, right? It went in my favor, it go against me, in my favor, against me, even a deeper retracement than this previous retracement. Then it went in my favor, against me, went in my favor, and it basically seems to be in the extended range right now. So I'm still in this trade, right? I don't try to micromanage it. As I've said, right, I'm leaving my stops here. If it hits, right? If not, I'll just manage using the 30-70 rule that I've just shared with you. Okay, so as I mentioned, right, all trading methodologies, all trading styles would have their pros and cons to it. I think it's more important that you as a trader understand what is the weakness of it and accept it, right? Don't try to, prevent losses because that is not possible in trading, right? The moment you try to prevent losses, it will lead you to do disastrous things, like having no stop loss, like pushing your stop loss further away, right? These are all disastrous actions that, is going to ruin your trading entirely, and you're going to, have to fund your account again, or you're going to waste, many years of effort, right, trying to learn how to be a profitable trader. Okay, so the last thing I want to leave you with is this potential setup that I'm looking at. Dollar Mexican, right? So let's use the same concept that we have learned earlier today. So this will be a swing trade for me as well. Again, I like to trade with the trend. So on a weekly time frame, you see you have a series of higher lows and higher highs, right? Higher lows, higher lows, higher lows, and perhaps this is a low over here. Higher highs, higher highs. So since we know that the trend is towards the upside, and again, if you use moving averages, right, the 20 is pointing higher, the 50 is pointing higher, even the 200, the long-term trend is pointing higher. So you know that in the big picture, you want to be on the long side. So on the daily time frame is where I'm interested to do business. So this is the area of support that I'm looking at. Right, you can see that this previously was the area of resistance. Price broke out of it, retest previous resistance, becomes support, then it trades higher, retest this area of support once again, trades higher, retest this area of support once again, and right now you can see that it's coming towards this area once again. So one thing to note is that support is not a line, it's an area. All right, it's an area, it's a zone. So don't treat it as a line, right? Because what could happen is that price comes here, then it trades lower, or it could just break out by a little bit and then it comes lower. So it's better to treat it as an area, right? Repeat it, area, area, area. Okay, hope that got into your head. So on this chart, price is coming to this area of support, right? So I draw the line here, but I treat it as an area. So on the forward time frame, right, I'm looking at the price action, watching how it unfolds itself. So right now you can see that price actually form a bullish engulfing pattern. And I can tell you 5 years ago, if I saw this, I'll be long for sure. I'll be long this trade 5 years ago if I said this, right? I'll go long at this close, stop loss below this low, and chances are, boop, I got stopped out. Okay? So I'm not saying it's wrong, right? But this is what I've learned over the years is that, just trading like this, right? Chances are, you're going to lose money. So that happened to me 5 years ago, maybe 4 years, I don't know. So what I'm instead looking at right now, right, since I've wisened up over the years, is that instead I'll be looking for the bears, right? I want to see how deep they can push the market lower. Because at this point in time, if you want to go long, right, look at this, right? On the 1 hour time frame, it's basically still in pretty much a downtrend, right? Lower highs, lower highs, lower highs, right? This is pretty much similar, and lower highs. So you want to go long down here, basically going long here, and I don't know, it just doesn't seem like the odds is in your favor. So what I would prefer very much is to see whether you see it on the 4 hour or the 1 hour, pretty much I think you can see the similar price action. I want to see the sellers come in. I want to see the bears come in and push price lower. I want to see how much they can push lower, right? Hopefully, I get to see smaller bodied candles where the bears are showing signs of weakness. They couldn't really push, and then the bulls come in and push price higher. So this is ideal, right? And then I'll probably get my buy stop order above this high. So this is ideally what I want to see. I think maybe the 1 hour is better to see, right? The 1 hour, again, smaller bodied candles towards the downside, and then if it does break out, I'll be looking to go long if price trades above this high. Alternatively, what could also happen is price just go into a range. Then it's even more clearer that it's the bears and the bulls are in equilibrium. And again, I'll be looking to looking to long if price trades above this high over here. Alternative, what could happen is that the bears to control and then it push price lower and nothing happens, right? The trend continues, or I would say the move, the sell down continues, and see where is the next area of value that I want to trade from. Okay, so yeah, this is all I have for you in this week's market analysis. I think I've run quite a bit, quite long this week, right? Because as I mentioned, I just want to walk you through the trades that I've took, how I'm going to manage it, and this potential setup on the dollar Mexican. So again, right, next 2 weeks I don't have any weekly market analysis for you. So if you want to stay on my list, if you want to be subscribed to the special training program that I've got for you, right, you can click the link below and you'll be subscribed automatically, and you'll hear from me, I think, over the next few days. So to all my other followers on social media, right, on YouTube, right, we'll be back on, I think, 2 weeks from now. With that, in the meantime, I wish you all good luck and good trading. If you have any feedback or any comments, feel free to leave it in the comment section below. With that, I wish you good luck and good trading. I will talk to you soon. Bye bye.